all. Welcome to another edition of Nucleus Investment Insights. Today we want to talk about greedflation and impacts on company earnings. So from tariffs. So I thought I want to do is sort of have a run through some of the factors behind tariffs, some of the factors we saw during the pandemic, and some of the factors we saw during Trump's sort of first round of tariffs, just to sort of talk about the overall effects. And given that we're looking at a reasonable jump in terms of the amount of tariffs we saw versus last time, and lots of different economic conditions. So yeah, just want to sort of put that all together and talk about company earnings in particular under greedflation. So just a reminder as well, everything you hear today is general advice in nature, does not constitute personal financial advice. If you do want to get some personal financial advice, hit us up on the website, book yourself in for a meeting, and we can have somebody talk to you about what might be right for your situation. But yeah, with no further ado, let's sort of jump straight into it. I think there's a number of different factors I want to sort of talk about, and I think there's still lots of debate in whether you call it academic circles or even sort of I guess there's a couple of different areas where you see this. One is academic circles. You do see it within central banks as well, and that sort of sits in that same sort of published research papers. And then you see a lot of research coming out from investment banks and others. And it's of varying quality, and sometimes people have their own axe to grind, and so you can get answers, depending on what answer you want. You can probably find a research paper backing it up, or at least an investment bank note sort of backing up whatever your predetermined outcome is. But the question is, what is for real in terms of these? And so I'm going to start with one of the I guess I'll put it. There's a prosecutor's sort of way of this, and a defender's behind greedflation. And keep in mind as well, so we're not talking about the tariffs yet. I'll get to the tariffs, the sort of first round of tariffs, in a minute. I just want to talk about during the pandemic or post-pandemic, the run-up in terms of prices we saw, and what different analysts are saying about that, because that sort of gives that, if greedflation is really a thing in terms of companies being able to push on price rises because they had a cover to do so, and everyone's hearing about all these pandemic inflation. Now companies that didn't actually have to put up their prices managed to put them up because there's not going to be as much pushback. If that's the case, and we do see some sort of broad-based tariffs, then that sort of seems to clearly sort of open up the possibility that companies can basically do the same again. They can then jump in, put in some price rises that they don't need to do, and to sort of take advantage of that. But whereas if the flip side is true, is that the greedflation isn't a factor, or it was mainly other factors, then that's much less likely, and you're more likely to see the prices or profits fall under tariffs. So yeah, so jumping into Albert Edwards sort of does a lot of these, and I'm going to use a couple of his charts just as an example. This was sort of one chart sort of came out in the middle of the whole process, particularly in the UK, where they'd had a sort of 10% plus CPI, and they talked about what was happening in food. And I've got a chart up just for anyone listening in the podcast, just showing that the food cost versus the agricultural index, and there's pretty good correlation between it. You typically see the agricultural index will rise before the food index, and then that will flow through over the next year or two. And so so you get higher prices in agricultural goods, and then a year or two later, or possibly 6 months to 18 months later, you get that the sort of flow-on effect through actual food prices that people are paying at the supermarket. And what was stark about this one was that we just saw the CPI on food prices sort of rocket to these levels that were miles above what they'd ever been before, or certainly in the last sort of 20 or 30 years. Whereas on the other side, we're seeing the agricultural index actually fall off. And it's this idea that, look, farmers aren't the ones making the money from this. It was more about the companies in between who were then jacking their prices up and taking more of the profits than what they should have. So, and something else you look at, a similar one look at from him is this idea of if you look at the US and they look at the whole of economy profit margins, which includes a lot of small businesses as well. And the idea is that when you run into recessions, and he sort of highlighted a few of those recessions sort of back in time, you get these big drops in profit margins where your sales slow down and costs sort of are where the costs are, and we really didn't see that during the pandemic, and in fact we actually saw that unit profit margins increase. So usually in the face of the economic downturns, and I guess the part just before we run into recessions where we see that increased inflation. Sorry, I should have started that back a step. Is that as you see the economy sort of building up and you get this inflation and demand supply, you can often end up with these lower profit margins. And that certainly wasn't the case during the pandemic. We actually saw a profit margin increase, and there's plenty of people who sort of subscribe to that idea that companies did manage to increase their profits. A lot of it was excessive and I guess unnecessary, and there was this whole sort of movement amongst a lot of companies, a lot of the large multinationals in particular, for price over volume. So effectively, what they were saying was, Coca-Cola, Pepsi, those types of companies were basically going, well, look, we've actually found customers do like to buy our product, and because we had to put our prices up, we found that actually the demand was nowhere near as sensitive as what we thought. And so, they might have been forced to put up their prices because of, in the initial stages, because of supply chain problems and other factors in the pandemic. And then because they found customers actually didn't, they put the prices up 20% and customers pretty much bought the same amount, is then they went, well, what happens if we put our price up a bit more and a bit more? And also looking at the whole demand supply, going, well, if I can put my prices up by 20% and I lose 10% of my customers, well, I'm actually still well ahead of what I was before, and actually I'm improving my margins a lot because I'm producing 10% less and selling 20% more in terms of in price terms. Right. So so that's sort of the side which says that greedflation was largely driven by companies, or at least 50%. I think the sort of numbers you see coming out is roughly half of the increases we saw in price were due to this corporate gouging, and half weren't. Now, companies themselves will very rarely own up to it. You sort of have to read between the lines in terms of what companies are saying, but within shareholder presentations, they don't talk about it as saying, we're ripping our customers off as much as we can and taking margins. They just talk about efficiencies and returns, and there's a lot of sort of words that are couched around this whole process, and price over volume, and other factors which are not coming down, which are sort of skirting around that issue. So, from my perspective, from what I saw from companies, certainly the commentary they were making was double. It was speaking out of both sides of the mouth. On one side, you're trying to say to your customers, we're just putting up prices because we have to, and costs are up, and blah 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 blah. And then you're trying to give shareholders at the same time this bit, like, look how great our margins are, and look what we're doing on that side, so that you're trying to sort of keep both groups. We keep your customers from complaining, but also tout your successes to your shareholders. The defenders of greedflation tends to be less about actively sort of addressing these exact issues, and more about talking about saying, well, look, real output was growing. How could consumers afford this? If it's just about prices rising, then that's a sign that if it's just, if prices rise in one area, then consumers need to cut back on another area. And so, this is more just about, it's more showing that there's actually excessive demand from consumers for things. And then another discussion is about, how much the supply chain problems actually sort of fed back into it. And that was certainly significant. Like, there's no doubts that was a significant cause. And even the prosecutors of greedflation will say that 50% was companies, and a lot of the other 50% was the supply chain side. But I guess the defenders, in saying there was no greedflation, will tend to say, oh no, it was mostly, or if not all, supply chain. Mostly supply chain. And then the other factor they'll come back and often talk about is excessive macroeconomic stimulus. Basically, they're saying too much money was pumped into the economy, and that was what was causing the price rises. And I think there's certainly truth to that. And for any of the countries in lockdowns and where we were seeing significant amounts of people not working, but still collecting payments, absolutely. If you're not producing, if you have a big chunk of the economy not producing, but still getting paid, so still buying things, then that certainly does lead to inflation, demand over supply. Excuse me for a sec. But on the flip side, that's sort of like a supply chain argument anyway. Is saying, well, that's whether it's disrupted supply chains, reducing supply, or too much economic stimulus reducing demand. It's sort of two sides of that coin, which is basically saying the whole thing was all from this supply chain and the macroeconomic stimulus, and an infinitesimal amount was from this greedflation. Whereas I think I'd certainly sit in the camp that more companies than not were benefiting from that greedflation. You definitely see it in the company announcements and what they're saying to shareholders. And then but the proof really is in that that earnings side. Is that the earnings, we saw margins grow for all these companies, and so it's pretty hard to sort of talk away the net effect of that, sort of seeing margins grow. So that's sort of the first part of it is the pandemic. Now that's going to be different to tariffs, but I'll sort of jump onto that in a minute. But just after this first message.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. So, okay, so that's the greedflation sort of front of it. The second part then is about the tariff side of it. Now, again, there's sort of, I guess, depending upon which side of the political fence you sit, or I guess your natural instincts, it comes back to how tariffs are looked upon. Now, I think there's certainly people out there that have this view that, look, all tariffs are bad. All they do is increase costs for consumers. And so all the cost is borne by consumers. And so you should have, as few tariffs as possible. The defenders of tariffs, and Trump is obviously one of those, probably overplays some of their strengths and talks about, no, it's all on the other side, and that you're punishing these countries that aren't playing by the rules. I think there's certainly some truth within that, and with all these things, I talk about a lot of these things being a pendulum. You can have too much of something and you can have too little of something. It's just trying to work out, where it is. And there's a pretty reasonable argument that yes, that pendulum has swung to too little in the way of tariffs, and that there are countries, China comes out as certainly being the number one, who are taking advantage of those low tariffs and implementing other mechanisms to unfairly disadvantage American workers or Australian workers or pretty much everywhere else around the globe, and certainly looking at the massive surpluses they're running in terms of exports is a sort of shifting that burden onto other countries to manage that. And I'm certainly sympathetic to that argument. What we saw from Trump's first round of tariffs, if you look at at those sort of the profit margins, and this time I've sort of broken it into two different parts. One is the S&P, so the largest companies, and then the other one is the profits on the non-farm business units, which is a much broader and includes all the smaller companies within that, or not all smaller companies, but a whole chunk of the smaller companies. And so, Trump came in 2016, put through those tariffs. You can see that for the listed companies, profits rose throughout that period. They were a bit weaker for unlisted companies. You'd probably say at best, profits were flat over that period. Profit margins were flat. But having said that, that really didn't apply to every industry. And I think you can certainly jump in and talk about winners and losers. I think some of the studies that look in particular at individual sectors where they're looking at the tariffs tend to say that what would happen is, say, international was, you say, sort of 10% tariff onto a product, is that the price of the good within the US would jump close to that 10%, and that what would happen is the domestic companies would largely pick up profit margins. And so what you're seeing was, or maybe the price wouldn't jump quite 10%. Maybe the price would jump 8%, say. So you throw in a 10% tariff, the price would jump 8%, and a lot of that 8% was domestic companies picking up that extra margin, and then also maybe competing a little bit on price and picking up some extra volume and things like that. But a lot of this was really just about improving margins for domestic companies. And when you look into something like the steel industry, as a good example, is that it does come back and go, look, it looks like it created a lot more jobs within that steel industry, and you did see expansion of production and things like that. But then the detractors will then point to job losses elsewhere in the economy and go, well, yes, we did. We added whatever it was, X thousand jobs into the steel industry, but then lost whatever 5 or 10 times as many jobs in other industries, whether building, construction, or you're going through your car industry or all these other factors where the input prices went up by that effect, and so the job losses were actually higher than what than what the gains were. Now, that's effectively then sort of coming back to being very sector specific in terms of what you're looking at. You're saying, okay, where are the sectors where the domestic companies are literally just going to pick up a price increase? And so the car industry would be one where you'd look at and say, the US car makers have got tariffs already on pickup trucks, and they just dominate that area in terms of I think it's a 15% tariff there, and so they just dominate that, and they run some pretty great margins on it, and they're just letting all the rest of their business fall away, or whether they're letting it or they just can't compete as well in some of these other passenger cars. And so you'd probably suggest then that, look, these tariffs come on, and that's one area where the car companies are probably just going to take larger margins out of this. They will expand their margins. They will do some more. But the question then is, okay, if all US consumers now are paying 5 or 10% more for every car that they're buying because of these tariffs, it's great for car companies picking up larger margins. It's great for employees within that, but that spending that the US consumers could have done is going to fall from elsewhere. And so there's this economic effect of saying, less growth elsewhere because you're letting tariffs sort of dominate these areas. Now, I did run a couple of charts a couple of weeks ago, just sort of looking at the various outcomes, and dig into that video if you're sort of interested in more of it. But what we're really talking about is roughly about a 2% tariff before, jumping to about 4 to 6%. And if you run through all the various mechanisms, and this is like the average tariff on across the US, and it could be running up to about 10%. And some of the estimates you see out there is that, for every 1% move in tariffs, you could probably have about a 5% effect on the overall level of profitability within the economy. But that's not going to be as evenly distributed, so that the industries that are protected will do better, and that the industries that aren't protected will do worse. So so net, a large increase in tariffs are probably bad for the stock market. You're probably looking at lower earnings, but that's going to, there's a whole bunch of other moving parts that I want to jump into. And so, because what we're, so we've spoken a little bit about the greedflation part. So prices are on the way up. Can companies put through bigger price rises? Answer is probably yes. Flip side is we've got these tariffs coming through. Some industries are going to benefit. Other industries are going to suffer from reduced demand within that. So that's the second part. And then there's some other macroeconomic effects that are the one I'll jump into just after this next message.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right. Okay. So we've got those rough factors in play. The other thing is we do need to. We can't look at all this in isolation. So this is part of a broader sweep of policy changes within the US. And I think there's an overall sort of effect of this is really talking about saying, okay, there's all these factors coming to play at the same time. So we're looking at higher prices for consumers, almost without a doubt. So higher prices for consumers. We're looking then at companies probably adding a little bit more to that. So where possible, and we'll get into that where possible in a second. But the flip side then is less demand from consumers. Okay, now it's worth thinking as well about what that actually means from to other factors that are sort of going into this. Now, one of them is lower taxes on companies, particularly domestic production is sort of one of the key targeted area that we're probably pretty likely to see. And potentially lower taxes on individuals as well. So, and it's worth noting that what we're seeing, certainly tariffs are a tax, and that tariff that is what economists would call quite a regressive tax in terms of saying, look, if you're buying a whatever it is from whatever you're buying from overseas. I'll leave cars out for a minute because that's probably more of that you can see some more extreme examples within cars. But if you're buying something from overseas, that tends to make up a larger part of a consumer's budget who's poor than a consumer's budget who's quite rich. Somebody who's quite rich might spend a lot of their money on things like travel and obviously some luxury goods and things like that, but a lot of it's services. And so, the question is if you're increasing the cost of all steel effectively for consumers, which goes into all these different consumer products, then you're adding that extra cost. Somebody might buy a blender, for example, that's got a little bit of that steel in there, and some other they've got a little bit of greedflation, or it's the competition from China that they've seen the price of that increase. Well, that's probably a bigger part of a budget of somebody who's on minimum wage or slightly above versus somebody who's quite well off. And so the idea is you're probably going to be increasing inequality, and all said and done, that's usually a poor thing for spending as well, is because the rich people tend to, if they've got excess, they tend to save it. Poor people tend to spend it. So on one side, you've got extra corporate taxes. You've got probably more employment, or a little bit more employment at the margin. On the flip side, you've got the tariffs coming in to reduce spending. You've got more inequality, and then you're meeting extra budget stimulus. So it does look like Trump is going to be spending a lot of money. There's some questions over how much he's cutting from federal budgets, and we have seen some sort of these interest rates certainly drifting downwards prior to sort of Trump coming to power. So I think that the natural trend in interest rates is down, but will Trump's policies be enough to rise those? So all those sort of factors are coming together. It probably points to and adding to that higher inflation. So the question is, which is going to be more powerful, the negative effects of what we've spoken about, of reduced demand, or the positive effects of all this stimulus? So and that question really comes back to again, we don't really know how much the budget is going to be. Most of what Trump is doing is executive orders, and a lot of them don't seem particularly illegal. From a and I've got a piece out in our performance report today that sort of runs into that. I'm going to dig a bit more into that next week. But the idea is that Trump's overall agenda basically seems to be, look, he wants to pass whatever law. Let's say it's getting rid of US aid, or it's firing people, or it's closing down the Department of Education. Pick whatever it is, or spending less on green energy, all that type of stuff. He's got absolutely the right to do whatever it is. He's been voted in. He can do whatever he wants. But the process is meant to be, they draft the laws, they get the laws passed by the House, passed by the Senate, and then he signs it into an actual law. Whereas what effectively is happening now is there's a signed-in law that says one thing, you must have a Department of Education. He's basically saying, I'm going to ignore that. I'm the president. I can do whatever I want. And courts are then effectively saying, no, you have to follow the Constitution. So we're in this part about, I won't dig too much into that because we're going to go into it to next week. But it's more about, is he going to get bogged down in this whole process? And so probably, if that's the case, probably the spending is going to stay high, and he's not going to see the cost savings. Or is he going to sort of basically push through and either ignore courts, or get it to the stage where the Supreme Court basically rubber stamps and says, well, yeah, you're the president, you can do whatever you want, and Constitution be damned, which is I'd say probably unlikely, but it's certainly not impossible from where we are at the moment. And so we really don't know what the net effect is going to be. Is he going to get through all his massive cost savings that he says he's going to do of sort of trillions of dollars, or is it actually going to be more about the headlines and highlighting that, hey, we got rid of $50 million of what was one of the ones, $50 million of sexual health, condoms for Gaza, before realizing that actually no, that wasn't Gaza in the Middle East. It was actually helping fight HIV in Gaza province somewhere in Africa instead. And so you see all these great headlines come out, but the reality is they don't actually care about the cost savings so much. They just want the headlines and to be seen like they're doing something. And that's So is it that, or do they genuinely want to make some serious hundreds of billions or even trillions of dollars of cuts like they say they do? So and if it's more about the marketing message about, hey, look at all these great cost savings we're getting and how we're what a great job we're doing, whereas and not actually really doing that much, then this is the stimulus is probably going to overwhelm and the negative effects, and we see company profits rise, and the US economy do all right. If they do make really serious inroads and really serious cuts to budgets, then that the outcome could quite significantly different. Right, so that's where we're sort of sitting. And what does that mean for companies? Yeah, look, we've just got to watch. At the moment, I think we're taking the view that if Trump's got a choice between making a large announcement that sounds really bad and gets the liberal press all fired up, but actually doesn't have much effect anyway, because it either gets stymied by courts or caught up in whatever it is, and he never gets to do whatever it says, but he gets to make the announcement. Then then he's pretty close to as happy as he's going to be, and I think that's probably the case. Is that he won't particularly care about these setbacks. He'll just he'll use that as an argument for people to vote for him then in the midterms, and trying to do other things. Maybe tries to extend his stay or whatever it is, but all on the back of these grievances of, hey, look how the deep state is thwarting me, without having to run the risk of actually causing real harm to the economy by making cuts that are too big. That's our sort of base case, but we could be wrong. Maybe he decides to just ignore courts and sort of push this through anyway and make sort of deeper cuts. So that's where we're sort of sitting. The net effect is, look, it's probably all right for companies, and probably good, and may well be good for companies. But there's always this risk of we don't know what he's going to do, and quite possibly he doesn't know what he's going to do either. Right. So jumping quickly to questions. Which of the sectors are going to be most likely to see price increases? This is where you really need to sort of focus between manufacturing and services. So services are less likely to see the price increases because they have to. Most of it's going to be, most of the tariffs are going to fall upon manufactured goods. So that's one part, which then probably comes back to saying, well, services companies, if they can use this as an excuse to push through some price rises, that's where they're going to see the margin increases. And so when it's something like a Microsoft, for example, deciding to put up price of its software and saying it's because of tariffs and other things, the tariffs might come into play on some of their shuffling profits back and forth between various countries to avoid taxes, but it's probably pretty meaningless in the overall scheme of things. And the price rises they're going to be putting through is using that as an excuse. Whereas other ones where more manufactured goods or something like a 3M or something like that, is a question of is that they're more likely to see some sort of genuine pressure on some of these prices until they can shift their manufacturing either back to the US or shift it around. Who else we got? We've got some questions on countries most likely to benefit the most. Now that's a tougher one. On some part you'd say, well, where does Australia sit within this? Does it earn a bit of a carve out because, well, we've got a pretty big surplus with the US rather than a deficit, and so so there's beneficiaries there for us, or do we end up in more where Trump is sort of bundles Australia in and just says, oh, we'll throw you in with everyone else? So I guess the answer there is I don't know. Australia in particular is one area that could stand to benefit, but my guess is that whatever benefits we do see from a closer US relationship are probably going to be outweighed by negative effects on China. What else are we? So someone actually does talk about manufacturing companies suffering and services company benefit. Is that too simple? That's probably not too simple. I think there's a broad brush. So that's what I'd use as a starting point for where I'm expecting negatives versus positives. But within that, you do need to be quite careful about where the manufacturing is being done. If you're talking about US companies that have quite sophisticated manufacturing chains between US, Mexico, China, Canada, and bouncing goods back and forth, then they can see some quite significant effects on their profitability. If you do see tariffs on China and Canada as well. companies that basically do all the producing in China and then ship everything to the US are going to see a hit. Companies that are doing their production within the US are probably going to get a margin rise out of this. And then the question is with that, what happens with Mexico and Canada? If there's little to no tariffs there, then those companies would fall in that same bucket of getting a price rise and profitability out of this. And so that's where, particularly something like the car companies within the US, that'd be one sort of natural one where you go, yes, great, they're going to pick up these big profit margin increases, but if it means that's very much dependent upon what happens with Mexico and Canada, because within some of these parts, the parts might be jumping back and forth, 10 times between the US and Canada before you finally get to the finished product. And if that's the case, and they're being hit by a 25% tariff on each way back and forth between, then that's pretty severely going to damage the profit margin. So yeah, it is going to be a lot of I think the simple view of manufacturing good, services bad within the US is a good place to start. But then before you sort of go too much into that theme, really digging into the companies and looking at their supply chains, I think is going to be very important. Right, with that, no further ado, I might just jump to our to the end of it. Just noting, thanks for everyone for jumping in. We're going to there is a performance report out, and we are talking a lot about some of the issues in terms of Trump's legal you have to say, well, I'm calling it an attack on the Constitution. We're going to jump in and talk about that next week. And really that whole idea is saying, well, what does that mean? So, does he end up tied up in courts for the next few years? Does he, crash through is what I'm calling it, which it seems to be his strategy is throw so many things at this. He's either going to be bogged down in courts and doing very little, or he's going to crash through, and you're going to look at a much more sort of dictatorial style of US government. And then what I look at is what does that actually mean for companies? What does it mean for the US economy? And is it necessarily a bad thing in the short term? And I think most people would agree that moving to less freedom and a more dictatorial society is sort of bad in the longer term, and particularly economically. But that the longer term can take years to play out. And you can often see, and there's chances for government changes and other factors in the interim. And so the question is, how should you be playing it, and how will we be looking at that? So that's all coming through for next week. We are on a whole bunch of different podcast platforms, whether it's Spotify, Apple Podcasts, most of the major and minor ones. On every Friday, 12:30. If you've got any questions, feel free to throw them in the chat. And we're on a bunch of different social media. You can sign up on our website if you want to get emailed out these blogs and podcasts on a weekly basis. And with all that, look forward to seeing everyone next week. Thanks.